All right. So this is a trend review of the Dow E-mini. Take a look at what happened when market pulled back on this daily chart right across the support level. That on a medium term time frame was this that pull back to support on the daily. This is how it looked on the medium term time frame. But that's not what I'm interested in. I want to hone in on smart money. All right, because this is what nobody gets. All right, smart money, they buy low and sell high. They take their profits on rallies, and then they buy back on pullbacks. Happens all the time. So this is the move down. See that? This is the rally, right? Rally into that daily support level. This is the rally, and then I got a buy signal here. But the question is this buy signal based off of some candle pattern or some make believe pattern or some A, B, all of that? No. You see, when the market goes down, smart money will enter. They will enter and they will buy a lot. Okay? They'll just buy a lot. Whether you're trending or counter trending, it really doesn't matter because rotations always happen in any trend. The only difference is it a big move or a little move? That's a difference. So this move down, smart money came in on this buy signal, and I'm going to show exactly how they came in and why this Wyckoff method, the primary piece of it, the heart of it, is being able to detect large traders. All right, at the turning points. The turning points, like here, is caused by buying low. Nothing more to it. Market goes down, they buy low. Okay, and it may go up a little and then they exit or something like that. Doesn't matter. But so watch this. It goes down, and you see a rally, market structure like just a rally, and then there's a rotation up. So what happened here? What happened here? What happened on the pivot? That's that's what I'm interested in. So for this, I use different types of lower time frame charts because I want to be able to detect the buying. All right, and many times you'll see the buying on either a 5 minute chart or a point figure chart or a tick based time frame. But one of those lower time frame charts will expose the buying clearly. Okay, it's not like a 5 minute chart always shows you the buying clearly. Sometimes it's a tick based chart or a point figure chart. I use all three, but I let the software detect it because I don't. It's gonna drive me nuts if I do it myself, right? So this right here, the buy signal. Let me show you what it looks like on the lower time frame. Uh, yeah, point figure. Now bring in the point figure. This is the rally down. When there was a rally down, you had buying. The first evidence of buying. Let me delete all this. No, delete. The first evidence of buying was here. One second. That right there. Okay? This was the climax right here. It doesn't the climax looks different, but one of its characteristics is high volume. So the volume was average volume was 5,422. The down volume here is 13,277. That's that's about 250%, you know. So that's 250%. That's abnormal, and it's not making much progress. Okay, so that was the first indication, but I want to see a sign of strength. So moving on, after that you have this. Average volume here is 7,114. You know how much up volume came in on this? 19,062. That's almost three. That's about 280%. 280%. Okay. So that's your sign of strength. All right. Now, this is not. This behavior here is buying the low. Like they sold the high, now buy the low. So this is not just occurring. I'm not looking at it like randomly happening. I'm looking at it occurring at the end of a rally or the end of a pullback. All right. Here, you see at the end of this rally, that volume on the point and figure, where is it? Anyway, the chart is somewhere. Like what was it, 20 something thousand or something? So that volume came in here. So the way I'm perceiving this is the market goes down and then they buy the low. And that's what you're supposed to do. Buy low, sell high. So they buy the low, and then your stop is near the danger point. The danger point is the low minus some. All right. So that this is the point where demand overcame supply. Okay. The law of supply and demand, as Wyckoff explained it, I mean it's like, oh yeah, supply stronger than demand, market will go down. If demand is stronger than supply, market price will go up. Demand and supply can be gauged by volume. And here we see that heavy volume coming in. So what does that mean? That means demand is stronger than supply and price goes up. At the same time, note that it can rotate at any other time, and you must always, as Wyckoff said, anticipate, and expect a change. But, they bought a lot here because they bought it on the down wave and the up wave, and it rallied back. So this is Wyckoff style, real Wyckoff, not the bullshit on the internet Wyckoff. It's a real Wyckoff that he explained. He talked about trading the turning points. That's what trading was about. It had nothing to do with any. He said think in waves, right? So if you think in waves, you have two types: up waves and down waves. You have rallies and pullbacks. And if you think in terms of that, you're trading rallies and pullbacks. And if you have up and down waves, what's in the middle? obviously a turning point. So just by thinking like that, you have an up wave and a down wave, and the middle is a turning point. What, that's the point. The point is trading a turning point. Now, how to do that is to be able to determine a shift from supply being greater than demand to demand being greater than supply. And when demand is greater than supply, it can be gauged by volume, right? And finally understood what that meant. That the law of supply and demand. But anyway, have a good weekend. Bye.